Yes, it says.
Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 196. And Richard is back. Hurrah!
Hello.
But before we get into it, he will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What have we got this week, Keith?
Well, first of all, some housekeeping. We'll be doing another one next week, and then we'll be away for a couple of weeks. First of all, the news. Well, lots going on in the world. Donald Trump continues to pile pressure on the US economy. Over the last couple of weeks, he has announced a new round of tariffs, 100% on patented drugs, 25% on heavy-duty trucks, 50% on kitchen cabinets, etc. The US Supreme Court is going to hear the first oral arguments about the legality of Trump's tariffs on the 5th of November. Reminder, none of the tariffs have been approved by the Senate or Congress, and they've been done by executive order. Now, the Supreme Court will rule on whether that was legal. He's also announced $100,000 one-off charge for H-1B visas, which allows highly skilled workers to come and work in the US, and that's a rise from $2,000 to $5,000 previously. Capital Economics estimates that many large corporations will simply pay this, and so far, Trump has got away with both the tariffs and all his little tax wheezes. The estimated cost to employers is $14 billion, but that all adds up to costs for US businesses, which is not good for them. And Republicans are threatening mass layoffs if Congress fails to approve the budget by 30th of September, and that's tomorrow. And in that case, there would be a government shutdown on the 1st of October. And the Republicans are saying rather than just putting people on furlough, they would fire people. In Europe, there have been drone sightings at airports in Denmark, Germany, Norway, and Lithuania, leading to airport closures. Now, that's not good. Is hybrid warfare coming to Europe to disrupt the economy? And finally, Nvidia has invested 100 billion in OpenAI. In economic news, the Fed met and cut rates by 25 basis points as expected. Jerome Powell, though, pushed back against market expectations of further cuts this year. The market is expecting 2 cuts. Trump appointee Stephen Millen voted for a 50 basis point cut rather than 25. The Bank of England also met. It held rates 4%. 2 dissenters voted for a 25 basis point cut. UK inflation was stable at 3.8%. Reminder, the Bank of England expects UK inflation to peak at 4% this month, September. The UK public sector borrowing requirement for August was a shocking 18 billion, far above market expectations of 12.8 billion. Expect further tax rises in the November budget. Oil rose after Ukrainian tax on Russian oil infrastructure curtailed Russian oil exports. But then, as of last night, the Ceyhan pipeline from Iraqi Kurdistan has reopened, so oil's fallen back a bit. Market news, precious metals have had an absolutely extraordinary year and an absolutely extraordinary couple of weeks. How long can it continue? Answer, much, much longer than I expected. US equities continue to grind higher. Commodities have been mixed. Copper and uranium were up. And UK yields have risen over the past couple of weeks, despite an hopefully imminent peak in UK inflation because the UK PSBR is not under control. Okay, some charts related to the news. This is gold, which has had an absolutely extraordinary year. Congratulations to Richard, up 45% year to date. Silver, even better, up 65% year to date. Platinum up 82%. Amazing numbers. This is the market expectations for Fed rates, and they're expecting the Fed to cut twice more this year. That seems aggressive to me. And then a further 2 times in the first half of next year. And then that's it. Polymarket is putting the odds of a US government shutdown at 66% this year, 54% for the 1st of October. Watch this space. Russian oil production has been broadly stable this year at 9.8 million barrels a day. But Ukrainian attacks on Russian refining capacity means that it's having to export more crude oil because it can't process it. And the Moscow Times, which is an independent Russian news website, says that Ukrainian drone attacks have reduced Russian refining capacity by 17% or 1.1 million barrels a day, leading to rationing of petrol in the regions. And this is the Ceyhan oil pipeline, which allows exports of Iraqi crude oil via Turkey, and that has reopened following. You remember it was closed because of disagreements over commissions. And on the 5th of November, the US Supreme Court will hear all arguments about the legality of Trump's tariffs. If it rules them illegal, they might have to repay the lot. And NVIDIA has invested $100 billion in OpenAI, which will allow it to buy more NVIDIA chips. Hurrah!
Yes, so the question there is, do we actually have a circular economy where they're beginning to support each other and creating the seeds of a unfortunate collapse?
Well, yeah, it's been going on for a while now, Richard. It's supported by investor inflows. So, OpenAI has relatively small revenues, but they're growing.
So I was listening to a podcast last week, and a guy on it, I haven't checked this out, was saying that NVIDIA keep changing their revenue recognition. And he is suspicious that their cash flows aren't all there should be, and that this investment in OpenAI is not what it actually seems to be on the face of it. That's what he was musing over. Do you remember those ETFs that the scandal of the ETFs 25 years ago, where they were all investing in each other, and it worked really well until it stopped working?
Yeah. Well, on that front, actually, we've got a section coming up on Bitcoin Treasury companies.
Oh, yeah.
So quickly before we move on, H-1B visas. So the US accepts about 130,000 petitions for initial employment annually. That's like 0.08% of the current labor force. And some of those applications are replacing foreign workers who leave upon the expiration of their visas. A visa lasts about 6 years. So Michael Clemens of George Mason University says that between 30 and 50% of the increase in US economic productivity from 1990 to 2010 was attributable to the rise in foreign science and technology workers via H-1Bs. Companies that hired H-1B workers saw their operations expand by 27% over the next 5 years, relative to companies that did not, without any decrease in US hiring. Hence, H-1B visas, which allow essentially the US to recruit the most talented people from around the world, have been great for the US economy. And if the US stops hiring or reduces hiring of H-1B these people, then that will be very bad for US productivity. And onto equities, Richard.
Thank you, Keith. Okay, so this is the weekly changes actually over the last 2 weeks. So basically the FTSE All World, FTSE All Share, and the Stocks Europe, the S&P 500, all not very much changed at all over that last 2 weeks, but all decently up on the year, between 10, 14, 16%. Russell 2000 up 1.2%. in the 2 weeks. Nasdaq not very much changed. Hang Seng not very much changed. But both of those up significantly in the year. The Topix down 1.3%, Bitcoin down 3.5%, and up 21% in the year. So I'm sure we'll discuss Bitcoin in a while. The pound against the dollar down 1.4%, the euro down 0.5%, dollar index up 0.7%. My question is the dollar index now starting to rise back up after having taken a bit of a battering over the last few months? And finally, the VIX fell 2.5% and is down 12% year to date. So there we have the All World Equity Index, the All Share, the Euro stocks, gone nowhere actually for the last 5 months. S&P 500 chugging up in the straight line. Nasdaq Composite, is it tapering off? Russell 2000 putting in a fairly strong run. The Hang Seng up nearly 33%.
Yeah, extraordinary given the Chinese economy is not doing very much. And actually, talking about the Russell 2000, I mean, the US economy appears to be slowing, and you know that earnings growth for US small companies has been very poor. It's basically been inflation. So, how sustainable is the rise in the Russell 2000? We ask ourselves.
Yeah, that's a good point, Keith. Topic's up 12% year to date. And there's Bitcoin, which again hasn't really gone anywhere since late May. The pound, fairly stable over the last 4 months. The euro actually slowly strengthening against the dollar. I'm not quite sure why. The dollar index, having fallen quite a lot at the start of the year, seems to have leveled out. And as I say, I wonder if it's going to start going back up a bit. The VIX, very low.
Yeah, extraordinary. Market is not seeing any clouds on the horizon.
Pension fund cash allocations are low and falling, which means that they are more invested, presumably.
Yep.
Household equity allocations are high. Actually, it looks as high as they were in 2000.
Yeah. Now, we have a section coming up on the only equity predictor you ever need. Do you remember the equity allocation? Just an update, because frankly, it would have had a terrible couple of years.
And the market is now close to all-time highs in terms of the CAPE ratio versus its historical average. And the S&P 500's free cash flow yield is the lowest it's been since the dot-com. It's valuations. It just shows that valuations are not good timing tools. So PE multiples have no relationship with the one-year future performance of the equity market. I guess they do over 10 years, don't they?
Yes, that's the point.
Unsurprisingly, so momentum is the best performing factor this year, i.e. buy what's going up. And the Mag 7 are now 34.9% of the S&P 500.
Yeah, amazing.
Top 10% of the S&P 500, i.e. the top 50 companies, presumably, equals 78% of the total market cap, so very skewed. And returns, earnings, capex, R&D growth, and contributions to AI-related stocks. And since ChatGPT launch have been extraordinary. They have basically accounted for most, I don't know exactly what, most of the return on the S&P 500. And I mean, I think a lot of commentators are saying, aren't they, that this is the AI bubble, that it'll do what the internet bubble did, blow off, and then the real winners of AI will start to appear over the course of the next few years.
Yes, that would be my expectation, frankly.
Big tech earnings estimate are outpacing the S&P 500.
Yep. So they're forecast to keep on having much stronger earnings growth than the rest of the market.
I don't really understand that. And the capex forecasts are strong. The Mag 7, the beneficiaries of those forecasts, strong forecasts. Foreigners currently own 18% of the US equity market, despite the fact that everybody said that people were going to bail out of the US market.
Yeah.
It hasn't actually happened.
No.
The first high for the Russell 2000 since November 2021, so 4 years. And as ever in the US, strong buybacks being a big supporter of the market. Bloomberg is forecasting that IPO issuance is going to increase. There hasn't been very much IPO issuance, has there? It's been quite subdued.
But what it's saying is buybacks are going to dwindle and IPO issuance is going to increase, which will turn net equity supply positive. And generally, that's quite bad for the market.
Yeah, that's a good point. So it's margin debt rising much faster than the actual market. So a lot of people are basically investing borrowed money in the stock market, which can work very well and it can work very badly. And cost 595,000 401k millionaires in the US.
Yeah.
And this is just showing, isn't it, that all various bubbles with massive decline, massive rises, at some point had correspondingly large fallbacks.
Yes, absolutely.
But timing that, of course, is very difficult. And part of it is understanding why the bubble has formed.
But what they all have in common, Richard, is that, it's momentum. People buy because it's going up. Yeah. That's, I think, the definition of bubble. If you go right back to the South Sea bubble, I mean, it's amazing how short the durations of some of these bubbles were. The rise of 707% in, 4 months.
Yes, that's a lot.
5 months. And then, others, gold, 78 to 80 rose 428%. Some of these are what they all have in common is that people are only buying them because they're going up. And on to commodities. So, quick summary: energy, oil bounced back, largely due to Ukrainian tax on Russian oil infrastructure. Industrial metals was mixed. Copper and cobalt did well. Cobalt is up after the government of the DRC, to the extent there is one, has allowed cobalt exports again, but on a quota system. And precious metals have been absolutely extraordinary. Congratulations to Richard and all holders. So on to energy. So Brent had a decent week, up 3.4%. WTI did very well, up to almost 10%. Is now down only 3% on the year. EU natural gas futures up 2%. Sadly, UK natural gas futures up almost 8%, as we're having a cold snap in the UK, presumably, and we're heading towards winter. US natural gas futures also up 5%. Coal bouncing back after its trend down earlier in the year, up 5%. And uranium, the bull market is back on, up 13% year to date. So this is Brent, still down 6% on the year, but has bounced off its lows. So some companies that are exposed to Iraqi Kurdistan. This is Gulf Keystone Energy, which has done very well this year, and it has confirmed this morning that it's back exporting, and this is Genel Energy, which also is a British listed company with assets in Iraqi Kurdistan. WTI has bounced back, only down 3% on the year. Numbers specific to the oil market, well, we're still getting inventory builds in the US. Over the past 2 weeks, total US oil inventories have risen by 1.4 million barrels, and that means the market is oversupplied. US crude production has been broadly stable towards its highs, and the Baker Hughes rig count is bouncing back as the oil price has risen. Interesting. So this is EU natural gas futures, pretty subdued actually. That's encouraging. UK natural gas futures off their lows, but much lower than they were last year, which is good. US natural gas futures bounced a bit. Coal rising again. Uranium. Is the bull market back on? So I'll read this out. Uranium futures in the US surged to above $83 pound in September, the highest in nearly a year, on fresh interest from physical uranium funds and long-term bets on nuclear fuel. Sprott reportedly continued to purchase Yellowcake to raise its third quarter purchases to £2.3 million. So Sprott is a financial purchaser of uranium for its ETF. The UK's Yellowcake ETF raised 125 million for further uranium purchases. Purchases by physical holding funds commonly trigger rallies in benchmark prices due to the thinness of uranium markets. This was after the US announced it would boost its strategic uranium reserve to buffer supply setbacks on growing import restrictions from Russia. And on to industrial metals, Richard.
Hey, Keith. So, aluminium down 1.5% on the week, up 4% on the year. Cobalt, as Keith said, up 5% on the week, 44% year to date. Copper recovering a little bit after the big fall that it had after the tariff debacle, up 2.6 on the week and 19% year to date. Iron ore actually pretty much unchanged the week and year to date. Lithium carbonate, likewise, although the precipitous drop in lithium carbonate prices of the last couple of years seems to have stabilized. Neodymium oxide, not unchanged on the week, but up nearly 60% year to date. Of course, China restricting rare earth exports. Nickel, pretty much unchanged. Tin, a little bit down on the week, up 18% year to date. And zinc, up nearly 4% on the week, but only down 2.7 year to date. It's aluminium.
That looks like a steady rise, actually.
Yeah. Cobalt, copper, iron ore. China has announced a ban on steelmaking capacity, new steelmaking capacity, and production cuts to try and avoid rising inventories.
Yeah. So the orange line is inventories which have been rising again. I've been producing more than they're consuming.
Yeah. Lithium, neodymium, nickel, tin, zinc. So on to precious metals, gold. Well, they all had a good week. Gold up 45% year to date, 3.5% on the week. Silver 11.7% on the week, 65% year to date. Platinum up 15% on the week, 81% year to date. And rhodium unchanged on the week, 55% year to date. Palladium 80% on the week and 46.7% year to date. I mean, this is all of. This is basically just down to geopolitics, I think. And the geopolitics is that there is a loss of faith in the US dollar as a safe place to put, if you're sovereign,
Yes.
as a safe place to put your sovereign assets. And that's one thing. And that basically has followed a series of sanctions that have been put in place by the US, culminating in confiscation of Russian treasuries. And secondly, the BRICS nations are fed up with being in the thrall of the US dollar and wish to have their own trading currency. And none of their currencies can be, quote, a reserve currency for various reasons. But if they all back their currencies with a similar quantity of gold relative to the total money issued, then they can effectively trade in their own currencies using gold to back them. So it's not the creation of a new reserve currency, and it's not actually deposition of the US dollar as a reserve currency. It's simply creating a new mechanism for trading, and they're building that out. And of course, that's creating huge central bank demand for gold. So that, I think, is the underlying process that's going on. In silver, there are rumours of severe physical shortages of silver, and there's also the fact that Trump has declared it to be a strategically important metal, and therefore the US will start stockpiling it. It's presumably other countries will do so also. So I think silver is actually undergoing a massive short squeeze at the moment, and who knows when that will stop and how high it will go. I think the jury is out. Platinum, typically platinum is roughly the same price as gold, and it's currently a third of the price of gold, or it was a third of the price of gold. That is basically correcting. And I think platinum is likely to double over the next couple of years to so that its price roughly equilibrates with that of gold. And palladium, I guess, is basically similar. And of course, that uses catalysts, and the EV dream of the minivans of the world is coming crashing down as the world realizes that EVs aren't actually the panacea that they were thought to be, which means there's a lot more demand expected for catalytic converters than was thought of a few years. So, excuse me, that's my little summary.
Well, very good, Richard. You've done incredibly well. Well done.
I would also actually add that, in my view, it's not too late to participate in this market. Obviously, it's not, one has to be careful, but I think that gold has, precious metals generally have quite a long way to run, and the precious metal miners likewise have quite a long way to run. That's my personal view. But as price increases, more care needs to be taken. So, gold's having its best year since 1979. It is slightly alarming to see that sort of almost vertical climb. But you could also say it's actually a discontinuity in a reset of the price, which I think that's what it is. But one has to be really, really careful. So I mean, you have to be really careful. Yes, and that's silver. So on a inflation-adjusted basis, the previous high of silver was $50, and that was the Hunt brothers, wasn't it, when they put on the silver squeeze, and that was 40-odd years ago. And obviously that was a slightly artificial situation because they did basically try to buy up the market, and then they were bankrupted by the bullion banks. But on an inflation-adjusted basis, $50 equates to $200. So the previous high of $50 now equates to $200. Platinum, rhodium, and palladium.
Okay, thank you, Richard. On to rates. Pretty depressing couple of weeks, actually. The UK yield curve is pretty unchanged. US yield curve actually shifted down, which is disappointing for the UK. The market is basically expecting the UK will not be able to cut rates as hard as other central banks, and that there will be no recession, i.e. the UK and all the global economy will just continue to grind on in the next couple of years, and central banks will not be cutting to stimulation. Now, I continue to disagree with that. I think so. We saw during the course of the week that PIMCO, the global bond manager, came out and said that it was buying UK bonds because it thought that the UK was not an outlier, that a lot of the inflation had been caused by regulation and taxes, and in due course UK inflation would come down and the Bank of England would be able to cut rates. So I agree with that. But so far I've been terribly, terribly wrong. So this is the Fed funds forecast. The red line is the Fed's own forecast, and the blue line is the market. Now, the danger is the market is going a bit carried away and is expecting far more rate cuts than the Fed will actually deliver. And they're forecasting that the US interest rates will hit 3% by the end of next year. And the market is essentially saying that the UK will really not be able to follow. And, since the great financial crisis, bonds have been an absolutely terrible investment, as I know to my cost. And finally, reminder, the US fiscal situation is totally unsustainable. And governments can get their fiscal deficits under control and stabilize their debt situation. So the UK, US, France, if they were to really put their mind to it. But they're not. And that means that it's unsustainable. Reminder, in the long term, interest rates have trended relentlessly down since records began, but you have this volatility, and we're in another volatile period. This chart is from a few years ago now. And the bond index, as volatility in the bond market, as measured by the MOVE index, which is the equivalent of VIX, is weirdly calm given everything that's going on. So this UK 2-year, and it's back above 4, which is extraordinary. So the market is expecting that UK interest rates will average 4% over the next 2 years. I just think that's wrong, but I keep
Is this not a case of the UK needs to issue so many bonds that it's going to have to keep interest rates up, Keith?
No, because the 2-year should be very arbitrageable versus the base rate. Yeah. So if you cut base rates to, let's say, 3, then you can borrow at 3 over the course of 2 years, get 4, and that's a great arbitrage. The further you go out, the more difficult it is to arbitrage between, base rates and bond yields, much less certainty. But the 1 and 2 years should be well anchored to base rates, basically.
Right.
10-year rising again, 30-year rising again, and frankly, that that chart still looks like there's it's rising trend. The US 10-year, however, seems that it is coming down compared to the 10-year, UK 10-year, which is stable. German 10-year still looks like it's rising. France, not great. Italy, actually stable. Greece, stable. Japan, has that peaked? Got the inflation numbers coming up showing the Japanese inflation is coming back down. And on to this week's economic data, Richard. Sorry, before we get going, a quick summary. So UK stagflation. Basically, economy is barely growing. Inflation is rising. We're expecting it to peak this month. EU stagnation. It's stable, but barely growing. US fine, but labour market softening. The latest nowcast in the US actually portray an economy that's not shrinking, as stable. It's not shrinking. And China stagnation. UK, Richard.
Okay, so as Keith has just discussed, UK interest rates at 4%, UK CPI month on month, 0.3% in August, and 3.8% and year on year, which was higher than expectations. So UK core CPI month on month, 0.3%, and year on year 3.8%, and that met expectations.
Yes. So, hurrah! UK inflation met expectations.
RPI month on month, 0.4% in August, and year on year 4.6%, and that met expectations for year on year, but expectation of 4.6% RPI is not good.
It's not good, no.
And UK inflation is much higher than its peers and is heading off in the wrong direction.
Yeah.
It's a mess. Services inflation is high at 4.7%. It was slightly down in August, but our inflation is too high. UK food inflation, 5.1% in August.
Yeah, not good.
No. And the world UN World Food Price Index up 6.9% over the last year.
So yeah, when we say UK food inflation is 5.1%, actually it's a global phenomenon. It's not just the UK.
And there's been some pretty massive inflation on individual items. So this shows beef 25%, chocolate 15%. That's due to a coffee. Oh, these are all my favourites, Keith.
Well, we've got a section coming up on UK beef inflation.
What's the inflation been on celery?
Yes, as you don't eat that, Richard, it's probably
Yes.
down 15%.
Yeah, that's right. Yeah. UK. What's pepper?
Okay, so let me do this. So briefly, while we're talking about UK food inflation, let's talk about another form of UK regulation, the packaged extended producer responsibility regulations, which have just come in. And what they're doing is they're shifting the cost of disposing of packaging away from local authorities onto producers. So producers will now have to pay a levy based on the weight of the packaging they use. That's important, the weight of the packaging they use. Small producers must report the weight of the packing they have produced once a year, big producers twice a year. Because it's done on weight, glass is particularly penalised. And so this all came into effect on the 1st of January. And
Can I just chip in here? So we know that microplastics are an increasing problem, and probably almost certainly an increasing problem to human health. One of the sources of microplastics is food packaging, and a big source of that is liquids in plastic bottles. So this is one of these classic non-joined up governmental approaches where they are taking the least healthy option, which is packaging in plastic, and making it more advantageous to do it.
Yeah. So this is going to add 5p to the glass in a bottle of beer, 9p to the glass in a wine bottle. So that's actually quite substantial. And once again, it shows how taxes are causing inflation in the UK.
Because this is actually just a tax increase.
It is, yeah.
Because it used to be paid for by council tax. Now it's not. It's being paid for by this charge.
Yeah. So the net tax burden has risen. Yeah. You're going to be paying your council tax and you're going to be paying this.
Like parking charges.
Yeah. So much of the inflation that the UK is experiencing is the indirect result of government policy, national insurance and employment taxes, and indirect taxes such as the PEPR. But these should be one-offs. But we continue getting loads of these one-offs. But eventually, UK inflation should fall back in line with other countries, he says. Anyway, Richard, carry on.
So, an interesting interlude. So UK retail sales month on month are up 0.5% in August, and year on year 0.7%. So better than expected.
Yeah, but year on year, negligible.
UK manufacturing PMIs in September 46.2, worse than expected, and not looking great, is it? But I suspect Jaguar, it was August, Jaguar hadn't shut down then, had it? UK services PMI mid-52 in September, below expectations. I mean, August is summer, September. Yeah.
But, that's quite a drop because it was, seemed to be heading right up and then it's dropped back.
And the composite PMI is 51 in September, below expectations. The consumer confidence index in the UK, minus 19. I mean, fairly stable actually at this rather negative level. UK PSBR, as Keith alluded to, 18 billion, which is 6 billion, 5 billion worse than expectation. And trust me, the expectation wasn't great.
No, exactly.
And borrowing has exceeded forecasts so far this year. Well, what a surprise.
Yeah, terrible.
Bring on Andy Burnham.
Yeah, not.
So the PSBR is not under control. Yeah. And current borrowing is deteriorating. We expect tax rises in the budget because we all know that taxes are good. Raising taxes is good for the economy.
Well, the trouble is, Richard, they've really dug themselves into a huge hole, the Labour government, because
They, they have, but I think we have to be honest and say that the Tories started digging it a long time ago.
they did. Yes, there's no question about that. But there's when they fail to cut benefits,
Yeah.
benefit bill keeps on rising, and they have not had the courage to tackle the triple lock. Now, we saw in the last episode how UK wages were growing at 4.6%. And according to the triple lock, that means that they're going to have to raise pensions in the coming year by 4.6%. So, advice to all viewers, please go on the HMRC website and check that you have a full national insurance history so that you can claim your full pension when you retire at the age of 67. It is the best investment you can possibly do. So I've checked and I have been topping up the extra years to get the full pension, and it has a payback period of about 2.5 years. So it's as long the triple lock is terrible for the country, but it's good for you. So make sure you
That
you
was
put
what
your
David Cameron thought when he implemented it. He thought, this is terrible for the country, but it's good for me.
precisely.
And what also shocked me was that the Tories voted against the cuts in social security absolutely disgracefully. They voted against the cuts on the basis of causing political trouble rather than voting on the basis of integrity.
Yes, totally agree.
That was
And that's why the latest opinion polls, Richard, show them shrinking again in the coming election.
utterly disgraceful,
Yeah.
totally disgraceful behaviour.
Yeah.
Goodness knows what Kemi Badenoch was thinking.
Mm. Well, they need to kick her out if they're going to have any chance of in the coming election, frankly.
Have you noticed, this is a bit of an aside, that nobody talks about what the Tories think anymore? It's Labour and Reform. And the views of the
Yes.
Tories is irrelevant, despite the fact that the Tories have 100 and however many is MPs, and Reform have 6 or whatever the number is. It's the Tories have basically written themselves out of the current political discourse.
Yes, I noticed actually the Liberal Democrats are getting more airplay than the
Yeah, but
Tories are.
I mean, isn't Ed Davey bonkers?
Well, he's good at getting publicity.
Yeah. Is this me? Yes.
Yeah.
Well, I don't know. The surprising thing about the economic surprise index is that it's not very high off the zero line. The Indeed job postings, actually, whatever it's telling us, it seems to be leveling off.
Yes. No, I think that's quite interesting.
Yeah.
I think that it's, stopped deteriorating.
Yes. Although, that's counterintuitive because what a lot of businesses are doing is they're not recruiting now because of the two reasons. One, the increase in employment costs, and two, the uncertainty over the Employment Rights Bill. So they're not recruiting, and the potential significantly increased costs of having staff with that. So a lot of employers have stopped recruiting and are looking to make their operations more efficient, which of course is very good for productivity, should be good for productivity. But that doesn't jibe with Indeed job postings leveling off.
Well, but they're leveling off at, 77% of their pre-COVID levels. I mean, at some stage they've got to bottom.
I think I've got contradictory data there anyway.
Yeah.
So these is going to guarantee pay work for young people unemployed for 18 months. So I think youth unemployment is a problem and it needs to be addressed. I don't know whether this is the best way of doing it, though.
Well, I mean, I totally agree. Youth unemployment needs to be addressed, but how can you guarantee people paid work? Who's going to employ them? What I mean, if you were to make them actually do some work for their benefits, like go and sweep some streets, pick up some litter, yeah, fine. But you can't just give them a job, right? The NHS needs some more brain surgeons. Here you are. Go and do it for 2 weeks. You know, who's going to give these jobs? I just don't know how they're going to actually achieve this.
Yeah, I mean, you're right, Keith. It is, but I'm sure behind the headline is a very well thought through, detailed plan. I don't doubt.
Yeah. Okay, let's
You're
leave it.
just, you're just not. You don't have confidence, Keith. You need to be more confident
Yeah.
in the abilities of our leaders. As I'm always saying, we
Yeah.
have to respect their
Well,
ability.
sadly, Richard, is it precisely the other way round. My problem, and the reason I've had such a disastrous couple of years, is I kind of have confidence in this country, whereas you've got no confidence at all. Put it all in gold, and they're doing incredibly well. You know. Anyway,
True.
moving swiftly on.
Oh yes. So sorry. So so in summary, Bank of England held interest rates at 4%, with two dissenters who wanted a further 25% cut. Inflation was in line with expectations, but too high. And September PMIs were all weak, with the composite falling to 51, and PSBR is a disaster area.
Yeah. Yeah, expect tax rises. Okay, and on to UK beef prices, which are up 25%. So, what on earth is going on? So, the cause is much higher input costs and a reduced herd. So, farmers are quitting the industry. A record 6,365 agriculture, forestry, and fishing businesses have closed in the past year.
That is extraordinary.
That's a lot.
That is. That's devastating. I mean, we're supposed to be making sure that for security purposes, we are able to sustain ourselves through, especially with all the geopolitical problems we've got going on in Europe,
Yeah.
Russia, and so forth. I mean, it's just nonsense. Presumably, there's just far too much. One of the reasons is there's far too much government intervention.
Yeah, bureaucracy. If you watch Clarkson's Farm,
Yeah.
it's extraordinary amounts of bureaucracy. But despite the falling beef herd, actually, the number of cattle sent to slaughter has been actually broadly stable. It is down a bit, but
Or
broadly
is that because
stable.
the herd is falling?
Well, they have been, yeah, they haven't been investing in growing the herd, basically. I'll show you the data in a second.
Yeah.
Um, so the herd has been declining even as beef prices have been rising. So the red line is the heifer price, which is up actually a lot over the past 4 years. But the black chart is the total UK beef herd, which is down. What's that? 20%? No.
Yeah.
Yeah, best part of 20%.
Yeah.
The beef herd has fallen by 11% in 4 years. The dairy herd, in contrast, was down only 1%. And the rise in cattle prices has been extraordinary, up 40% between January and May.
What's the deadweight price of a civil servant these days, Keith?
Whatever it is, it's too high. The only slight good news is that the prices do appear to have peaked short term. The CPI beef and veal index is in blue. So it has lagged the price of a steer. Now, the really bad news is that there's no supply response. So it takes about 2 years to raise a calf to slaughter. And when you look at the
So,
proportion of cattle by age, there's no,
so,
nothing's going to improve in the next 2 years.
so prices are likely to continue to rise.
Well, I think there'll be a demand response to balance the
Yes.
market.
Yeah.
So a big problem for the UK is it has lots of small, unprofitable farms. So when you look at the beef suppliers, i.e. farmers, only the top 25% make money. The bottom 75% lose money. The bottom 25% steadily lose money. So this chart shows the overhead cost per bull, and the right hand, the x-axis shows the number of cows in your herd. So the more cows in your herd, the lower your costs, basically. And only the top 25% made money. So the green dot is total income. The bars are total costs. So the bottom 75% all lose money.
Mm.
So hence, even though the price of beef has risen, price of cattle has risen, a lot of these farmers are barely profitable. And farmers have also been squeezed by rising input prices. I mean, some of these are really big. Straw for bedding up 120%. Plus, we've had obviously labour and council tax, etc. And so all UK agricultural sectors have experienced very high input price inflation over the past 5 years. Basically, the best part of 50%, 45% for most of them. Actually, beef has got one of the lowest increases. And so, unsurprisingly, what you are seeing is falling cattle, pig numbers in this country. This is, frankly, what I think the big problem is that we are moving away from direct payments towards agri-environmental subsidies. So we're paying UK farmers for their husbandry of the land and not for producing food. So farmers have an incentive to make sure that the stream run is clean when it runs through their land, but no incentive to keep on it to produce, but no incentive to produce more cattle.
We are just drowning in a swamp of politically correct government policies that I guess they've been evolving. Actually, I think they've been evolving since the time of Cameron, really. And the chickens, chickens are coming home to roost, aren't they?
Well, actually, so this is pigs down 20%.
Sorry, the pigs are coming home.
Exactly. Well, they're not coming home. They're
the chickens are flying. They're flying. Chickens are flying the nest.
Sheep population down 5%. I was expecting that to be down more. Poultry populations are up over the same period. So
the chickens are coming home to roost.
Yeah, exactly. I mean, frankly, how you breed, slaughter, and package a whole chicken and sell it in Tesco's for £3, I just don't understand.
No, I agree. Well, they have massive farms, don't they?
Yeah. So bottom line is, UK herd numbers are stable despite the massive rise in cattle prices. There's no supply response. Hence, to balance the market, there's going to have to be a demand response, i.e., we are all going to have to eat less beef. And this is not just a UK story. This is beef prices in the US. My God, that's, beef is becoming a luxury item, frankly. Brazil also up a lot, but nowhere near as much. So essentially, we are competing in the global market for import beef from Australia and Brazil. So there's no easy substitute. A farmer selling a 325 kilo steer carcass today would get around £700 more for that animal relative to a year ago. That's a lot of money, but there's no supply response. 75% of beef farms are unprofitable. So the rise in prices, essentially what you're saying is that a lot of these farms are sort of lifestyle farms that are being supported by government subsidies, eco subsidies, and they've got no incentive really to increase the number of cattle they're producing because their cattle themselves are not terribly profitable.
Yeah.
Bottom line, there's no supply response, therefore beef price is going to remain high, I'm afraid. Adjust your consumption basket. And onto the EU, Richard.
Thank you, Keith. So this is EU loans to companies year on year. Bank lending, presumably, mostly. Up 3% in August. So that's looking quite healthy, actually.
Yes, improving.
Yeah, and EU loans to households year on year is also improving quite rapidly from that sort of nadir in early 2024, up 3% in August. EU M3 money supply is growing at around about 3% actually at the moment.
Yeah. The thing is, I'm we last week this segment on the true money supply, basically saying that I'm just wondering whether the money supply numbers are of any relevance at all now, because essentially the money supply is a stock number, and we're no longer using cash and notes, and we're directly accessing our bank accounts via, technology. And therefore you can see that, the stock of notes and coin in circulation may stop growing or start to shrink. Instead, what you're getting is an increase in the velocity of money in the bank accounts. So you don't need as much actual, money supply to fund the transactions, because the money's moving faster.
Well, I guess the number needs to include debt, doesn't it? I'm not sufficiently familiar with all the different M's, but the true money supply has to include debt outstanding.
So the true money supply, Richard, is an Austrian school measure of the money supply, and it concentrates just on money used in transactions. So that is money in your current account plus notes and coins and
Yeah, it depends what you're trying to measure it for, doesn't it? When I say true, yeah. I'm saying, to me, the actual amount of money in circulation is, I guess, cash plus it's debt, isn't it? I mean, but if you talk about money creation, money is created by debt.
Yes.
And the number you need to measure is how much money is being created. So you need to have, your measure needs to basically be the amount of debt.
Yeah. Okay. Yeah. But M3 is notes and coins in circulation, short-term deposit accounts plus short-term savings accounts.
Yeah. So to my mind, what needs to be measured is the debt level.
Yeah.
I don't know what that. I don't know what that's. Oh, you just look at the graph of debt, don't you? It's like enormous.
Yes, absolutely.
Anyway, so industrial production in July was 0.3% month on month and 1.8% year to date. So sort of ticking over. Not great.
Yeah, we're not great.
Construction output was better, 3.2% in July.
Yeah, no, surprising actually. That's turned a corner.
Manufacturing PMIs falling in September.
Yeah, that is a real break in the trend. Last month, if you'd asked me, I was saying, well, EU manufacturing is really recovered, and now it ain't.
And services PMI up a bit in September, but pretty level for the last year or so.
Anemic.
Yeah. And the composite, 51.2, again, hasn't really changed since spring 2024.
But actually, that's seems to be trending upwards, you'd say.
So the EU Economic Sentiment Index, 26.1 in September, and the Consumer Sentiment, minus 14.9. The EU current account, positive to the tune of 35 billion in July. And the Economic Surprise Index chart is there. Germany, indeed, job postings moving up.
Yeah, seems to have bottomed.
The French one, I would say, isn't moving up. It doesn't yet appear to have bottomed. So, summary for EU, industrial output slightly beat expectations. Construction, it looks like it might be in recovery. Manufacturing, PMI fell, service PMI rose. Composites rising slowly, and job openings appear to have stopped falling. So,
yeah. And on to the US. The Fed met and cut interest rates to 4.25%. So that's for a range of 4.0 to 4.25%. Stephen Millen, the Trump appointee, wanted to cut it by 50 basis points. Now, Q2 GDP, we had the final estimate, and that was revised up to 3.8%, which is very strong. But a reminder that is being distorted by imports and exports. So the Q1 number was wrong. Well, again, it distorted by the massive surge in imports. And then when those imports stopped in QT, our GDP bounced back very strongly. PCE inflation came in on expectations at 0.3% in August, 2.7% year on year, core at 2.9. So heading in the wrong direction, frankly, and are well above the 2% target. Despite that, the Fed cut interest rates because of a softening labour market. The good news is that 6-month annualized PCE inflation is coming down, he says, cherry picking some numbers. The bad news is that, and we've talked about this before, how since COVID, the seasonal adjustment of US inflation has tended to see inflation higher in the first half of the year and lower in the second half of the year. And now we're seeing surging inflation in August. That's bad. That suggests that inflation is resurgent. 72% of US inflation components are rising faster than 2%. Now, as part of the personal consumption expenditures statistics, it showed the actual raw spending numbers, and that looks absolutely fine. US economy doing okay. Import prices, great. Essentially 0% year on year. Export prices, 3.4% year on year. Better than expectations. So not seeing a surge in import prices from tariffs. Retail sales, really good. 5% year on year, 0.6% month on month in August. Industrial production going nowhere, 0.9% year on year. The Trump putting in tariffs to boost domestic production, well, it ain't happened so far. Durable good orders bounced back in August after a couple of negative months, up 2.9% month on month. Manufacturing PMI fell, but still positive in September. Services PMI weakened slightly, but that's still a good number, 53.9. Composite was at 53.6. Chicago Fed Economic Activity Index continues to show that US economy operating slightly below average. The National Association of House Builders, that's a bad number, close to its all-time low. The number of building permits, you can say, I think that is a trend, and a trend that's heading definitely in the wrong direction. But housing starts are broadly stable. So permits, as a future activity, suggest housing starts are going to slow, but they're not slowing yet. New home sales had an absolutely extraordinary month, leaping. And pause, have a read of the text box. What it's saying is discounting and promotional offers were probably behind the surge. Existing home sales remain very subdued. Initial jobless claims, there hasn't been a surge. As we talked about at the time, it was all due to the state of Texas one-off, and there's been no sustained rise in jobless claims. Continuing jobless claims are also stable. Indeed, job postings, well, not great. Still softening. Link up, still softening. But when we look at the nowcasts, Dallas 2.1, it's pretty stable. Atlanta surging 3.9. Now we know that the Atlanta Fed numbers are particularly affected by imports and exports. That suggests to me that imports are falling. New York Fed GDP nowcast, and this is the one we like, at 2.55%. Very good. And not heading down, heading up. St. Louis Fed at 0.2%, much less optimistic. Economic surprise index has bounced back. Trueflation doesn't seem to be there this week. Some charts related to the US. So this is interesting. We were talking previously about the AI boom, and it is having a real impact on the US economy. Investment spend as a percentage of US GDP, the 2000 tech boom was 5.2%. The current AI boom is 5%. And the spending on data centers is offsetting the decline in office construction. So when you look at CapEx, the rise in CapEx has mainly been due to this AI superscalers, although there has been a rise in general CapEx, but CapEx as a proportion of revenues for the non-superscalers has been broadly stable, i.e. sustainable. For the AI superscalers, it's been going through the roof. So tech investment as a percentage of GDP is a near record, dot-com levels. If you exclude tech CapEx from GDP, US GDP growth would be pretty close to zero. So we would be close to recession. Turning now to US inflation, well, the FT's measure of US core CPI inflation is ticking higher. Will the US really be able to cut rates 2 times more this year? And the proportion whose prices are increasing is not good. That looks like persistent inflation in the US, and US financial conditions are already loose. Why should the Fed be loosening them further? But tariff revenues are continue to grow. The number of tariffs, as we reported earlier, just keeps on rising, now at 370 billion annualized, or 1.2% of GDP. The macro policy advisors had an article in the FT this week saying why the US labor market would continue to weaken, and that would tend to bring inflation down and cause the Fed to keep cutting rates. And they're saying that Trump has cut the Department of Education budget by 50%. We're now going into the new school year, and macro policy advisors estimate that teacher hiring will be 200,000 lower than last year. Federal severance and buyout programs, which were announced under Doge, if you remember, most of those expired in October. So the people who took those programs would stay in job until October, and then they'd be kicked out. And now we're approaching October. Cuts to healthcare spending and research will result in layoffs at hospitals and research foundations. ICE raids are stopping migrant workers from going out or showing up to work and will have an economic cost. Tariffs will have an effect on trade, slowing growth. So that's from macro policy advisors. So US summary, US economy continues to tick along. Inflation, we're expecting it to rise mildly and then decline again mildly, but currently it's rising. And all the nowcasts are saying that the US economy is doing just fine. Okay, on to one chart, and everyone is super excited about AI, okay? But when you ask them, when the US Census asks businesses whether they have been using AI, actually, the proportion of large businesses that are using AI is declining. So a couple of weeks ago, we talked about this MIT study, which suggested that many firms' experiments with AI are failing, and this census data would seem to confirm that. And everyone's getting super excited, but Richard's point about how any new technology takes decades to fully embed, I think remains the case. And so you're seeing this initial excitement, but it's going to take a long time for firms to really work out how to use it best in their businesses.
I think so. I think so. There's an article in the Harvard Business Review, which I haven't read the article, but I've read a synopsis of the article. And basically, what they did some research, and the research that they did indicated that where AI is used by employees, it produces eloquent text that then has to be rewritten by other employees or by their managers, and it creates more work than it saves because the person using the AI doesn't review what's come out.
Yes.
It just sends it on. And as we all know, AI does produce very eloquent text, but it can be also producing at the same time complete nonsense or partial nonsense. And I think that is a real issue. I also think, I've used a couple of recently. I used a help system on a share trading platform, well-known share trading platform, which was clearly sort of powered by AI, and it was truly dreadful.
Yeah.
It was really awful. And I finally managed to find a phone number to call, and I called them, and I explained to them that I thought the help was truly awful. But the problem was it never answered the question. But it kept saying, does this answer your question? And you say no, and it would take you round in the loop to your starting point.
Yes.
And so I think that it's and the other thing I would say about AI, I use AI a little bit. Every time I use it, I don't pay for it. I know it's costing someone a lot of money collectively, and I don't really know who's paying for it. But when I do, it's shareholders.
Yeah.
And at some point, the chickens are going to come home to roost here, and they're going to have to start charging a lot of money for a service that doesn't work very well.
Yeah, well, I agree with that. So a friend of ours' daughter works for a large UK accounting firm, and we had dinner with them last week, and she was saying about how she had a couple of interns, and they would just stick stuff in ChatGPT when asked a question and not review the output, just present it straight to her, and it's all wrong.
Yeah.
So actually it's not increasing. They then have to do a lot of work, revising, checking it, etc. And it's not helping.
No, it doesn't help. It's very unnuanced. I mean, it's extremely clever how it works. It's undoubtedly extremely clever, but it doesn't actually contribute to a sort of administrative type of role, as far as I can see at the moment. I mean, it certainly can contribute to some things. I think it probably contribute to robotics and helping robots understand their environment, for example.
Well, Rich and I have both been reading this book called Co-Intelligence about how to use AI. And one of the takeaways I took away from that is that actually you have to have some knowledge of how to use it and how to get the best out of it. And I think, this friend of ours' daughter, she was basically, what her experience is that a lot of these interns don't know how to use it properly and don't know how to check it and don't know its limitations. And so in order to use it properly, it's going to take a while for people to understand how best to use it. And this naive, just throwing questions in and it taking the answer at face value just doesn't work.
I think that's right. I did. I sent it to you, Keith, didn't I? I actually queried Claude AI about. I said, it's a 2023. Your knowledge is based on 2023. Would gold be a good investment? And my estimate in 2023 was that gold would be a good investment. The Claude's view basically was that it wouldn't be a good investment, or it would be a mediocre investment. It came up with all the usual reasons why it would be, but it wasn't actually ever able, without me prompting it, to come up with the reasons as to which were known then.
Yes.
With the reasons as to why it actually was a good investment. And so but everything it wrote was very eloquent.
Yeah.
It was just not correct or impartial,
Yes. Okay, and on to food prices, Richard, global food prices.
Okay, thanks, Keith. So this is the global meat price index.
So that's up a lot.
And it's starting to move up again, isn't it? It's been fairly stable-ish from mid-2022, and now it's moving up again.
But that's, 40% since its lows? And that's a lot.
Yeah. Cereals price index continuing to drop, actually.
Yeah.
Quite substantially. And not surprisingly, one of the components of cereals price index, wheat, falling.
Yeah, but notice this is a nominal chart. Yeah.
Yeah.
And you are back down to pandemic levels. We've had 20% inflation since then.
Yes.
So that, real wheat prices are down.
Yes. Rice, sort of a different chart to the cereals chart.
Yeah, we did this good news last week, was talking about the increase in crop yields, in rice crop yields. And essentially, as Asia has increasingly industrialized and you get fertilizers and machinery going into the field, so you're
Yeah.
getting a big increase in
Nice.
productivity.
Yeah. Corn. So the UN, the dairy price index fell back from its 2022 peak and it's now has risen sharply actually over the last couple of years, falling back a bit at the moment, but what's that? It's like a 30% increase over the last couple of years.
Yeah, so it's basically it's cattle and dairy and animals.
Yeah. Vegetable price index. Actually, that's up quite substantially from
It is.
2024.
It
It's up
is, yeah.
20% or so. Sugar, I had that big spike, didn't it? And it's falling back from that big spike. So, as summary, he says it's basically the food inflation really is limited to meat and dairy, and the supply response will occur probably, but it's quite slow.
Mm.
So, but not good
Yeah.
news. Not good news for the average shopper.
Well, it's good news for vegetarians. It's just not good news for the average
Yes,
shopper. Yeah.
yes, that's very true.
Okay, and on to crypto treasury companies. Now, what are these? So, a crypto treasury company is one that holds the majority of its assets in a cryptocurrency such as Bitcoin or Ethereum, making their shares a proxy for the underlying assets. But the advantage of a crypto treasury company is that they can take on debt or equity and therefore become a sort of geared play on crypto. So the most famous crypto treasury company is Strategy, formerly MicroStrategy. Others include Marathon Digital Holdings and Bitmine Immersion Technologies. So Michael Saylor, the CEO of MicroStrategy, or Strategy is it now, has promoted this idea that crypto treasury companies should be valued on MNAV, which is the ratio of the market cap of the company to the value of the underlying crypto assets. But when you just look at MNAV, you're ignoring any cost running the company, the value of any other businesses that the company has, whether it has preference shares or options, etc., and also ignores debt. So all of those would be in the valuation of a real company. So if you take the example of this company, which holds 1,000 Bitcoins at a Bitcoin price of 100,000. So total Bitcoin NAV is 100 million. There are 10 million shares outstanding. The MNAV should be $10 a share. But the market price is $17.50. Therefore, you have a 75% premium to the share price is a 75% premium to its MNAV. Now, question, why should crypto treasury companies trade at a premium to MNAV? Well, the dynamics of these crypto trading companies are quite interesting. So the idea would be that because you've got a leveraged vehicle, if you think that the Bitcoin price is going to go up, then you might want to pay a premium for that gearing. But also, the if a crypto treasury company is trading at a premium to MNAV, then you get this self-reinforcing feedback loop. So to illustrate this, let's say that Portfolio Matters has a crypto trading company and it has one share in issue, and that share trades at $100 with an MNAV ratio of 5. So each share is backed by only $20 of crypto. So we have a huge premium between the share price and the crypto, underlying crypto. So if the company were now to issue a second share, which it sells in the market at $100, it could use that $100 to buy $100 worth of crypto. So it then has two shares in issue and $120 of crypto assets. If the MNAV ratio remains at 5, the market value of that crypto assets becomes $600 worth of market capitalization. So each share is worth $300. So you get this feedback loop whereby if your shares are trading at a premium to the underlying crypto, you are incentivized to keep buying crypto assets to boost the share price and the value of the underlying crypto. You get this self-reinforcing positive feedback loop.
So the problem with strategy, and I don't know their balance in detail, is that they borrow money to buy crypto, which makes them a geared play on crypto. And I think the problem they've got is that if Bitcoin, because I think they bought Bitcoin, and if Bitcoin drops by, let's say, 50%, which we all know it can do quite easily, and it does regularly do so, then it becomes insolvent.
Yeah.
And that's the problem. That presumably is why this valuation principle has been introduced, to try and avoid on paper that scenario. But the scenario is that strategy and all of those companies are high risk, highly speculative, geared investors in crypto. And actually, I want to say something about crypto, but I don't know if this is the right point.
Go ahead.
So I've been thinking quite a bit about crypto recently, and I've been thinking about it in the context of gold, because as we all know, the Bitcoin is promulgated as being a store of value and the modern equivalent of gold. And it's not, for a couple of reasons. One is that you can only access it if you've got electricity. And the second is that it is actually vulnerable to confiscation by the shutting down of servers and so forth. So there are ways that it can be compromised. And it's clear that if you look at the BRICS, they're not buying crypto to any significant extent. They're buying gold. So the premise that Bitcoin is better than gold because you don't have the storage problems, you can trade it in an instant, has basically broken down. My sense is that the rise in crypto has probably stopped, and I think ultimately they will fall back to their transactional value, i.e. the value they have in underlaying transactions on the internet. So, and I suspect what will quite possibly happen is people will start to exit crypto and move into physical assets. So I think, and I actually think that this thing with the MNAV that Michael Saylor has developed is a symptom of the fear in the market of what might happen. So that would be my prediction. And as I think I said previously, I have occasionally had crypto and not a huge amount of it, and I don't have any more. I'm completely out of it. I probably will never buy any again. And I think that the projections that it's going to go up tenfold, personally, I think it's wrong. It won't happen. I also think that this issue with stable coins investing in crypto is, or rather stable coins being a sort of valuable form of crypto is spurious, and basically stable coins invest in treasuries, and so they are as stable as the treasury that they invest in.
Yes.
And I think that probably the dramatic rise in valuation of the crypto in the crypto realm generally, I suspect is over, and that they will now begin to fall back. The only proviso there is that if particularly the US undertakes another bout of QE, crypto tends to trade in line with the Nasdaq. The Nasdaq
Yeah.
will probably go up. So that's it. But I just think it's reaching the end of its days as a speculative asset.
Well, I've always been deeply skeptical, so far totally wrongly. But I think you've also didn't mention the other big drawback with crypto is that you can be hacked. It can be stolen very easily, you
Yeah.
know. And once it's stolen, I mean, if you have a have physical gold, people can't just hack your computer and steal your physical gold. And if you hold an ETF, you have rights.
Yeah.
Whereas you hold Bitcoin, you have no rights at all. I mean, you're intentionally outside the regulatory regime,
Yeah.
and you can never get it back. It's gone instantly.
Yeah. I agree.
So, sorry,
no, I was going to say, so there we are. You heard it here first.
yeah. Well, returning to like the incentives. So as Richard was talking about, yeah, in the case of MicroStrategy, etc., you've got debt. If the value of your assets falls below the value of your debt, then you're in deep trouble and you're going to have to liquidate those assets. So you would then cause a self-reinforcing negative cycle. But more than that, if your MNAV dips below 1, then you can no longer issue shares to keep on buying crypto. In fact, the loop then serves to work in the other way around. The incentive is to liquidate your crypto to buy back shares. So this is shares of MicroStrategy, now called Strategy. Had a great run, but volatile. Shares now coming off. This is Marathon Digital Holdings. Shares have been volatile. And a lot of these companies, they don't start off as crypto holding companies. Basically, they start off as some other failed investment company, and they decide to, jump onto the latest fad. This is Bitmine Immersion Technologies. When you look at its long-term charts, that's all you need to know. Speculative nonsense, basically. And if you go on to...
I didn't know there were this many.
Yeah, there were a hell of a lot of them. I mean, dominated by MicroStrategy, which has got 639,000 Bitcoin. But, in total, they've got 1 million Bitcoin. There are all these little shitty ones. And this is Strategy's MNAV. You're looking at the orange line at the bottom. It used to be 3. It's now 1.25. So it's fading. And when you look at the MNAV ratios of all these companies, you'll see that when they announce they're becoming a crypto treasury, they get this pop that then tends to fade back towards 1. And this is as of last Friday, the MNAV ratios of the major players, and not great. I'd say just over half are trading below 1. MicroStrategy is trading at 1.25.
It's bizarre that this measurement doesn't account for any debt, because debt gets paid off by selling the crypto. That's the only way to do it.
Yes, exactly.
It doesn't earn any income.
Yeah. And then at the bottom here, you have CEP. Yeah. So that has a MNAV of 5%. So really terrible. So just quickly, what on earth is it? So Cantor Equity Partners, it's an acquisition vehicle specializing, looking for crypto projects, basically. Speculative nonsense. So bottom line, crypto treasury companies were a symptom of investor enthusiasm for crypto. Their dynamics are self-reinforcing. If they've got premium to MNAV, then it's great. You basically issue more shares, buy more crypto, and you get an upward spiral. The trouble is, when it ceases to trade at a premium, then those dynamics don't work anymore. Investors get bored, and the moment they start selling, it all starts working in reverse. And on Richard's point about, strategy with a debt, with debts, substantial debts that can only be paid off by selling crypto. And if the MNAV goes below a certain point, then it would have to liquidate the crypto. To my mind, it's inevitable that happens. When the markets know there's a key vulnerability, they will test you. Simple as that. So
are we recommending a short position on strategy, Keith?
no, I wouldn't recommend anything, but it's just like avoid like the plague.
I completely agree. But it doesn't look, the future doesn't look bright, does it?
No. Right. Now I've almost finished preparing a huge section on Argentina because I want to know what's going on there.
Okay.
But we'll do that next week, next Monday. And an update on the only stock market indicator you will ever need. Richard, do you want to do this?
Yeah. Fire away. So this chart's high investor equity allocations equals low future returns. So this is lagged. This is 10-year subsequent return, basically, on plus average, plotted against average investor equity allocation. Remarkable correlation.
Yes. But this study was done originally in 2013.
Yeah.
So the last data point you had was the 10 years to 2013.
I feel an update coming on, Keith.
Well.
So the aggregate investor allocation to equities is explained by this formula, which I think is probably best you to look at and work through.
Yeah.
And the original work used data between 1951 and 2003 and just showed a strong fit between the 10-year return and the AIAE indicator, as you can see there.
Yeah. Now, I have to say, I saw this, and to me, this is an immediate red flag. Because you see how many data points there are. They are using overlapping 10-year returns as independent data points, and they're not independent data points.
They're doing it every year, presumably.
They're doing it every year. And so you can't do that. You will get very dangerous and misleading returns. If you did 10 regressions with...
Yes, you take every 10-year point, as it were.
Yeah, and that would be valid.
Yeah.
But this is not valid. This is dangerous.
Okay, so however, the data set has been expanded to 2023, and you get a correlation of 85% using this methodology. But I completely agree with what Keith says. It'd be interesting to know what the correlation is if you just do it every 10 years.
Yeah. Yeah. So this is illustrates. Yeah, this is just super dangerous.
Yeah, and this is the 10-year correlation of 78%.
Yeah. So I think this is more meaningful, actually, just looking at the chart. And actually the fit over the subsequent 10 years was pretty good.
Yeah. Yes, it is. So
but Richard, what I'd say is we don't have data. Obviously, the last couple of years have been really, really strong for US equities. There's right up here. Yeah. And you'd have been forecasting,
So it does cover one. This doesn't actually really cover the period of QE, does it?
No.
And QE began in 2009-ish. So it doesn't really cover that period. And one of my theses, which may or may not be correct, is that the US market doesn't crash because at all, just basically continues to rise as it is, because ultimately the Fed is going to have to do more QE. And we know there's a strong correlation between the US stock market and QE. So in which case, clearly this whole this thesis breaks down. So I'm I'm aware that there's a lot of data that says the US stock market is overvalued, and hasn't it done so for many years now, ever since we've been doing Portfolio Matters, actually.
Yes.
My sense is that it may ultimately crash if there's some sort of seminal breakup of the financial system. But my sense is that until that happens, or if and when it happens, I'm not saying it will happen, the US market is going to continue to rise, and the valuation metrics sort of become less and less meaningful.
Well, this is where it is now. If the historic relationship holds, you're forecasting very poor returns for.
Yeah, I mean, completely. Part of the problem is that the US simply can't afford for the stock market to drop.
Well, exactly. Yes, you can't.
And effectively, it's recycling Treasury, borrowed government debt. It's recycling it into the stock market and then into tax takings, and it can't stop that. It can't stop that cycle, and that sort of pseudo wealth generation cycle. It can't stop, which is why I think actually the Fed is always going to, or the plunge protection team, whatever you like, is always going to step in and stop the market from falling, or stop it from falling significantly.
Well, it's going to try.
It's going to try, and at some point it will fail.
Yeah.
But who knows when that might happen?
No, I completely agree. Well,
shall we just buy a private island somewhere, Keith? And
well, I think you can now, mate. I'm not sure I can. Okay, and last section. I've been meaning to do this for a while because I found this really interesting and very disturbing, actually. So this is from the FT, and one of the things we've been talking about is the impact of the social media revolution, essentially, on society. And the young people, I think all the metrics of their mental health are really deteriorating. So conscientiousness, this is basically really impacts your employability. Are you going to do a good job? Do you care about doing a good job? Look at, our generation compared to the new generation. They don't care. Neuroticism, agreeableness declining, extroversion declining. Basically, one of the things I've been thinking about is how in a society like, Japan, lots of introverted people who can now just hide in their bedrooms on the internet. They don't need to go out. You now have essentially you can opt out of society and just have your introverted, social media Facebook group rather than being actually going out.
And an AI friend.
Yes.
Who tells you what you want to hear all the time.
Yeah. And they've got poor attention spans. Ability to make plans or persevere, easily distracted, careless, more argumentative, less outgoing, less trusting. This is just not good. And these are not small effects. They're quite big. So this appears to be primarily in the English-speaking world. So when you look at young people's mental health, their well-being, self-reported, you'll see that it's been deteriorating in the West, but it's actually broadly stable in Europe. So what are we doing wrong? Now, the point of this article was saying that actually a lot of it could be caused by anxieties about house prices. But I don't think there's, I think it's too broad. When we go back to this, unable to persevere, easily distracted, that is not to do with house prices. There could be underlying, anxiety about how you're going to get on in life, but that's a bit too specific. I'd put all this down to social media and the penetration of social media, and it's no coincidence to me that, the social media is largely a US, i.e. English-speaking phenomenon.
Yeah, it's a tough one, isn't it, Keith? It's clearly, not at all good, but it's
No.
very hard to know precisely what it is. I mean, I'm sure social media plays a role. It's interesting that Western Europe is so different to us,
Yeah.
which and I'm really surprised by that.
So bottom line, the thing is, this survey is well established and the science is solid,
Yeah.
and it portrays a society where the notion of society itself is being quickly eroded. And I think technology is basically enabling people to become much more socially isolated. And actually, their ability to interact with other people in real life is deteriorating. So, investment implications, well, it's going to get worse unless anything changes. So, good for media, games, and tech companies, bad for providers of social goods like pubs, restaurants, drinks manufacturers.
It's also bad for the economy, isn't it? And bad for social cohesion, and
Very bad.
you
Yeah.
know, bad for our way of life.
And on to inflation watch, Richard.
Thanks, please. Okay, so what have we got? UK 3.8% in all these are August numbers. Let's just look at UK 3.8% for core CPI, 3.1 in the US, 2.5 in the EU, 2.7 in Japan, 0.9 in China. China may well be correct because obviously they've got that huge property problem they're trying to work their way through. UK is the only one with RPI. RPI at 4.6%, as we discussed, is jolly high. And
yes.
I did hear, I think that the Bank of England is stopping QT because or significantly reducing it. So
yes. Sorry, I forgot to mention that. So the MPC meeting, they decided to reduce QT from 100 billion in 2026 to 70 billion. And actually, that should be good for the Chancellor, but the market actually sold off on the news, so the market may have been expecting even more. But that is good.
the US is still doing QT for how long? I think I suspect it might not be for that much longer, actually. The EU has got so many 3 and 4 letter acronyms for various schemes that it has that I think one loses track entirely of what it's doing. I have no doubt that it's also purchasing French government debt behind the scenes, and possibly others. So there we are. Japanese inflation.
Yeah, interesting. It's coming down.
Yeah. Japan is sort of the dog that didn't bark, isn't it? Japanese.
Well, this. Let's hope this is what happens in the UK. Look, you'd say 2 months ago, it's gone. My God, it's going through the moon, and then it doesn't. That's cool.
Yeah.
Okay, that's it for inflation watch. Thank you, Richard. On to recession watch. So we had the conference board leading economic indicator having forecast recession, which I reported relentlessly in the period 22-23, is now forecasting recession again. And previously it was very good. Now, it was totally wrong last time. Let's see. The reason is it largely concentrates on manufacturing, and manufacturing is increasing small part of the US economy. So this has been driven by drop off in new orders. I thought this was really interesting. Look at this. Freight in the US. That's not good. Goods purchases, goods shipments around the country, fall. And when you look at the US labor market, you should normally get a decent premium for switching jobs to incentivize you to move jobs. But now you ain't. So that suggests the labour market is fundamentally quite weak. And for the first time since the pandemic, there are more job openings than people to fill them. Long-term unemployment is rising. That's not good. These are people out of job for more than half a year. When you look at the distribution of customers' credit, so US consumers' credit ratings, essentially it's becoming more extreme. There are more people with very poor ratings and more with much better ratings. Inequality keeps on rising, which the credit score corroborates. Almost 50% of US consumer spending comes from just the top 10% of people. Extraordinary. And when you look at wealth, it's concentrated amongst the baby boomers, basically house prices and equity wealth, benefit people with assets. So there are reasons to think the economy should be weakening, and there are some signs it is weakening, like freight. But, the nowcasts all suggest that US economy ticks along just fine. Sorry, I lied when I said the last segment. This very quickly, I thought this was amazing. We know somebody who's gone on antidepressants, and they were saying that a very high proportion of women over the age of 50 were on antidepressants. So I actually downloaded the data from the NHS. And this is the number of prescriptions of antidepressants in the UK. And it's risen by 40% over the last 10 years, which is pretty amazing. And women are more than twice as likely to be prescribed antidepressants than men. And 25% of women aged between 50 and 65 are on antidepressants. Like 1 in 4. I found that absolutely astonishing. You note that actually there are prescriptions for antidepressants for children as young as the age of 4. Amazing. 12% of men above the age of 50.
Yeah.
Not good. We're paying for all that. Okay, finally, on to good news. So this is the number of proteins that researchers can measure in your blood from a single vial of blood.
Bring on Elizabeth Holmes.
Yeah. Look at that. Isn't that amazing, though? So can get a lot of data out of you. What we do with it or not is another matter. You have to join the huge queue to go see a doctor to say, found this weird protein in my blood. Sorry, this is meant to be good news, isn't it? Anyway, look how marvelous technology is. And concluding comments. Well, Richard is doing absolutely unbelievably well with his call that the world economy is fucked, basically. And I
never put it that way, Keith.
Yeah, well, I'm bloody depressed because I've got it totally wrong. I've been thinking about just how badly I've got it wrong, and I've struggled to see how I could have got it much worse, frankly. So, not great. But Richard will be taking over from here and giving you some, top quality advice.
No, I don't. We don't give investment advice, but people that know my positioning for ever since we started, actually.
Yeah, exactly. And so I've had a really.
There were some fairly bleak years.
Yeah, well, I'll be all right medium term, but it's depressing currently.
Yeah.
And on that note, I hope you are all doing really well. And there's lots of ways to make money that I've fully just failed to appreciate. Having, do this every week and just like failing to actually react to anything. And continuing with my belief that inflation will come down and then bond yields will come down. And, when you get UK government bonds at inflation plus 2.5%, you don't need anything else, honestly, for long term. But, so clearly when Richard made 40 or something gold this year, that's much better. And we'll leave it there. We will be back again next week to talk about Argentina. In the meantime, thank you all for watching. Please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only. and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.